Welcome. My name is Travis Clark, and I'm a U.S. economist with Visa's Business and Economic Insights team. Joining me to explain our outlook for the year ahead is Wayne Best, Visa's Chief Economist, and Michael Brown, Visa's Principal U.S. Economist. Before we dive into our outlook for 2025, let's take a moment to reflect on a major theme from 2024, which was that the Fed was able to raise rates and get inflation under control without inducing a recession. This is sometimes referred to as a soft landing. So Wayne, how did we pull off the soft landing?
Well, it's interesting. It was really kind of two parts. The consumer and businesses were actually pretty flush with cash. Consumers very much deleveraged during the pandemic, paying down debt, and we saw their disposable personal income growth that allowed them to keep growing their spending despite some of the high interest rates that we had overall. Further, businesses, refinanced a lot of their debt at interest rates that were frankly at almost generational lows. They were also sitting on a lot of cash and allowed them to really keep hiring and investing despite the high interest rates that we had during this time.
All right, so turning to 2025, Wayne, how would you characterize what we are likely to see in 2025?
Well, I think first off, GDP growth is forecast to grow at a slightly slower pace than what we had over 2024. Further to that, the pace of job growth is also expected to remain relatively modest as the labor market becomes more balanced in terms of labor supply, essentially those looking for work, and labor demand, job openings specifically. Now, income growth is also expected to hold up, but the balance in the labor market will really keep wages growing more modestly than we have seen over the last couple of years. And finally, while we expect the Federal Reserve to continue reducing interest rates, this will also have a positive benefit to growth this year.
Okay, so Michael, what key factors do you see influencing growth in 2025?
Well, if you take a step back and think about some of the major attributes of our forecast for the year ahead, it really distills down into 5 key themes. 1, slower job growth, but not for the reasons you might think. We think on the consumer front, there'll be a tale of two halves, but also a tale of two consumers. More to come on that later. In terms of the inflation outlook, we're expecting inflation to come down closer to the Federal Reserve's 2% target, but probably not fall below that level. In terms of the interest rate outlook, as Wayne kind of alluded to, we do expect a shifting policy landscape with lower interest rates, and that should help boost credit availability in the economy. And finally, I think 2025 is going to be a year where we're discussing fiscal policy a lot. So we'll unpack that theme as well.
All right, so let's start unpacking these. Wayne, can you start us off with the outlook for slower job growth?
Yeah, so we expect that job growth in 2025 will be a lot of like what we saw in the latter half of 2024. But because of the labor force constraints will be the factor, as opposed to some of the economic weakness that you typically see with slower job growth. And there's a number of reasons behind that. We've talked about them before. An aging population. We've got 12,000 people turning 65 every single day between now and the end of the decade. We're not having as many kids as we used to. And lower immigration is going to probably create a downside risk if some of the potential policies that are being implemented and being discussed and how those further might impact the labor supply overall. We have a plateauing workforce participation rate that is also going to create a little bit in tighter labor markets overall. And this is going to support strong wage growth for workers, but also pose some hiring challenges to businesses specifically.
Yeah, that's interesting. I mean, Wayne, given our labor market outlook, though, what does that mean for the consumer?
Well, again, I think as Michael mentioned earlier, first off, we expect the 2025 consumer spending growth to be a little bit more moderate, but consistent, supported by steady gains in inflation-adjusted income growth, very big driver of spending. Lower interest rates, which will certainly help, and even wealth effects from the stronger housing and, frankly, the stock market also. We've kind of categorized this as 2025 being a tale of two halves and two consumers. Let me explain. The first half of 2025 is going to be characterized by maybe more frequent purchases of lower ticket items, frankly, due to the high interest rate environment that we're all experiencing. And the second half is going to be characterized, we feel, in terms of larger ticket purchases. Interest rates will start coming down, and this will allow for more spending on high ticket items. Think home improvement, furniture, appliances, autos, etc. Also, 2025 will also be a tale of two consumers. So we'll have the affluent and middle income consumers, and frankly, they continue to be in a very good position to grow their spending thanks to good, strong income gains that they've had, as well as wealth gains. The lower income consumers are going to struggle a little bit more. Let's face it, they've exhausted all of their excess savings, and they've had to rely pretty heavily on credit cards and consumer finance loans to really help maintain the level of spending that they've done.
Thanks, Wayne. So let's shift gears to inflation. Michael, what are we likely to see in 2025 regarding inflation?
So there's a couple of key factors. The first half of the year, at least, we think is going to look very similar to the second half of 2024. And what I mean by that is gasoline prices, oil prices are coming down, but there's one stubborn component of inflation. We call it core inflation, but essentially all the other stuff, not counting food and energy. And the problem here is that tight labor market Wayne alluded to earlier is driving up a lot of the prices in the service sector. And that stickiness is really frustrating, as you can imagine, for the Federal Reserve. So that's why we say inflation's going to fall closer to the Fed's 2% target, but probably not below that.
I would also add that new tariffs in 2025 will likely mean some potentially higher inflation. And this could impact spending in 2025 as a result of lower purchasing power overall.
That's right, Wayne. And in fact, if you look at our forecast, we've actually started to build in some of the impact of the announced tariffs to date. So that would include tariffs on Canada, Mexico, and China.
Okay, so Michael, given the backdrop of inflation, how do we expect the Fed to respond?
Well, it's interesting. Let's just take tariffs as one example. You think about the impact of tariffs, it's really a level shift in prices, and it's based on a one-time event. So we're not expecting this year-on-year inflation effect to persist beyond, say, 2025. And as a result, we don't think the Fed really responds much to the inflation generated from tariffs.
It ends up not being a structural issue.
Absolutely.
And more of a one-time shift.
Absolutely. And so the implication here, when you look at our forecast for the Federal Reserve funds rate, for example, they're still cutting, we think, 25 basis points per quarter, and that takes our federal funds rate, the upper bound, down to about 3.5% by the end of next year. Now, the important aspect of this, I think, for our client base and consumers overall, is the fact that the yield curve starts getting steeper. And that's important because when that yield curve steepens out, we tend to see a lot more credit availability in the economy, and that can help power consumption.
Right. Okay. So our final key theme for 2025 is the question of what fiscal policy will look like under the new administration and Congress. Michael, what should we expect from fiscal policy in 2025?
Well, it's certainly going to be the topic du jour, I think, as we think about the contours of next year. A couple of very important nuances here. A lot of discussion around tax policy changes, both on the business side of the economy, but also individual tax policy changes. Those discussions will happen next year, but the impact on the economy, we think, will be a 2026 and beyond story. Sort of more clear and present to the 2025 fiscal policy outlook are two key themes: immigration and changes to immigration. And we think this could have a potential impact of restricting the size of the labor force, and that could potentially kickstart inflation, as we talked about. The other aspect of things is the potential for tariffs. And as I mentioned, we have built in some of this impact, and it ripples through our economic outlook, as you would imagine. Inflation is a little bit higher, and as a result, the real purchasing power of consumers is reduced on some of those imported items. And as a result, we're expecting more modest economic growth. So again, a little bit more nuanced around it, but the tax policy changes you'll hear a lot about next year, more of a 2026 story.
Thank you, Wayne. Thank you, Michael, for your insights today. Before we sign off, I did want to highlight some risks to our outlook that are important to keep in mind. The large federal budget deficit could lead to higher interest rates and require even more money be dedicated to servicing that debt, which would leave less available for productive investments. So due to those issues, we see growth in the deficit as a downside risk to our outlook.
You know, there's another one that we should think about also. It's the potential escalation of foreign conflicts. We do have a number of those around the world. So a lot of geopolitical events, and any of those could start to strain supply chains even more, which frankly would be inflationary and be a downside risk to our forecast and outlook overall. However, a de-escalation is also potentially in the cards, right? It could really look at the current geopolitical conflicts, and they could actually be additive to the global GDP, boosting manufacturing exports from the U.S., which would be an upside risk to our growth outlook overall.
On behalf of Visa's Business and Economic Insights team, we wish you all the best in the year ahead.